and welcome to our latest Insider interview. I'm Caldwell, and today in the studio I have with me Sebastian Lyon, who is fund manager of the Trojan Fund and Personal Assets Investment Trust. Sebastian, thanks for coming in today.
Carl, thanks very much. It's a pleasure to be here.
So Sebastian, to kick off, could you explain the investment approach? You can invest across a variety of different assets. So which types of investments do you typically invest in?
Well, Carl, the two investments, the main investments that I run, the Trojan Fund and Personal Assets Trust, are capital preservation vehicles. What we're trying to do is we're trying to protect the value and then grow it. And also income is residual, so we're not desperately trying to generate a high level of income. The capital preservation is more important. We don't want to reach for yield and make a mistake. But we have a sort of go anywhere policy, really, in terms of the fact that we're a long only fund, so we don't short. We don't buy derivatives particularly, but we do buy traditional investments, which we feel can generate good long-term, good risk-adjusted returns for our investments. And those would include, and primarily, the biggest driver to our returns over the 24 years that I've been running this mandate has been equities, UK and US equities primarily. So we start with stocks. We have a qualitative bias towards those stocks, and those are the things that probably driven about 2/3 of the returns of the fund. And then the balance is in complementary other assets, which will probably do well when equity markets are doing less well. So we have the potential to invest in fixed income, index-linked bonds, which I know we'll come on to. We could invest in commodities, particularly gold, which we think has a very special role within the portfolio. And then cash and liquidity, short-dated bonds. And we're not frightened of having cash. Our cash levels go up and down depending on whether we think the prospective returns are good or less good. So we've had as much as 1/3 of the portfolio in liquidity, in cash, and as little as 5%. So it's not a hot potato sort of burning a hole in our pocket. It's something which we use very carefully on the basis of where we see the prospective returns. We're not frightened to have liquidity over short to medium term periods. So those are really the four key asset classes which drive the overall returns of the portfolio.
So the two portfolios, I've seen them described as mirror funds. So how similar are they, and are there any major differences?
There aren't really major differences between, if you're talking about the Trojan Fund and Personal Assets Trust, one is an open-ended fund, an OIC, and one is an investment trust. Generally speaking, the assets are very similar. I wouldn't say they're absolute mirrors. The way that I run money is I tend not to micromanage the portfolio. So i.e., if we get flows in on a sort of daily basis or flows out on a daily basis, I don't sort of micromanage and fiddle, and that just increases costs, that increases frictional costs. So I don't do that. We'll tend to remove the portfolios as and when those adjustments take, maybe over months or over 6-month periods. But if you look at the portfolios, they're very similar, but they're not absolutely identical, and that's the way that I run it. In terms of the differences, if you like, differences are really the fact that for personal assets, there's a different fee structure, and there is a board that's there to keep me honest, frankly, and that it's a board who's very engaged in the trust. I've been investment advisor since 2009, fund manager on the trust since 2020, and we have 5 board meetings a year. They're engaged, they're aligned, they're big shareholders in the trust themselves. The one difference, I think, which is important to point out compared to some investment trusts, in fact many investment trusts, is we do have a hard discount control mechanism, which is written in the articles of personal assets. So there will be many keen investment trust investors who say, well, I'll buy personal assets, but I'll buy it when it's on a 10% discount. It hasn't been on a 10% discount ever in its life, to my knowledge, certainly not since the 1990s. We have a discount control mechanism, which means it trades close to, and by that I mean plus or minus 2% to NAV. So the widest discount you'll see is probably a 2% discount, and the highest premium you'll see is a 2% premium. So that's a sort of difference compared to other investment trusts. But there still are people who like the investment trust model and prefer PAT over Trojan, and similarly the other way around.
So if you're looking for a bargain, personal assets is not the trust for you?
No, I'm afraid it's an affordable luxury.
And in terms of the bond market, around 1/3 of both strategies are in USTIPS. Could you explain what USTIPS are and why you're focusing on this particular part of the bond market?
Yeah, so index-linked bonds and TIPS, Treasury inflation-protected bonds, which are the US equivalent to UK index-linked, are sort of hybrid bonds, if you like. They do two things. So they work like fixed interest securities, with the exception of the fact that you get inflation. So you get CPI or you get, in the UK, RPI. And what that means is when there are periods of higher levels of inflation, you effectively get that inflation paid to you. Now, for long periods of time, as was the case in the last decade, you had a relatively low period of inflation, so you were getting a bondish type return. But occasionally, and as we saw in 2021, 22, 23, we saw a 40-year high in the UK RPI and in US CPI, and we got, as investors in those bonds, we got that inflation. So they perform much better on the basis that you keep duration short, which we can come on to talk about, but on the basis you don't take huge long-term duration risk with the bonds, i.e. you take shorter-term risk, you get that inflation. And the bond doesn't move materially in price, but you get paid that in terms of both the capital value and the income. So that is why they are, to some extent, beneficial. And the other thing is one has to look at obviously the valuation of those bonds. At the moment, USTIPS are yielding a 2% real yield. So you are getting inflation plus 2%. So if you hold it for the duration of that bond, let's say it's a 2028 bond, you will get 2 plus whatever the inflation level is, 3, 4, 5%. If it's 9%, you'll get 9%. So we think we have our liquidity, which is our short-dated bonds and our cash. But we think these are sort of, if you like, a sort of hybrid in the middle, whereby they're liquidity effectively, but they have the potential to have a better return than cash. And they're relatively low risk investments as well. So we've held them for quite a long time. They were really helpful during that period of inflation. If we're right and we're in a more difficult environment for inflation, there's a lot of there's strong views now that inflation's come back down and that it'll stay low. That's certainly possible. But I think in a post-COVID world and in a world of higher geopolitical risk, in a world where there is less globalization, where commodity prices are generally speaking more volatile, I think there's a risk that inflation could come back again. And if that is the case, then TIPS will not be a bad place to be compared to fixed income.
And another key defensive asset that you have is gold. You have around 10% in gold in both portfolios. Gold's performed really well year to date. Could you explain why? And is 10% the typical amount you have in gold? Would you go any higher than that?
Yeah. So, well, there's two answers to that question, Carl. The first is sort of why do we hold gold and why 10% or there or thereabouts? And the other thing is what's happened to the gold price. So the first thing is we hold gold and have held gold in the portfolio going back to 2004, 2005. It's compounded at 11% per year in sterling terms, in fact a little bit more than that, but it's done that at a different time to the stock market most of the time. And so it performs differently from other asset classes and fixed income as well. And so it's a really good diversifier. And to some extent, it does a job of hopefully making us returns when perhaps other asset classes aren't making the returns. So it's sort of almost in lieu of derivatives or portfolio protection, and yet it costs us very, very little compared to derivatives. Now, it doesn't do the job always by design, but then actually derivatives don't always do what you expect them to do, and they're very expensive, whereas gold in the past has generally done what we would hope it would do. And so it's been a very helpful contributor to the portfolio. In terms of the size of the holding, we think, and this is sort of almost by process of elimination, we think around 10% plus or minus 2, so sort of 8 to 12% is about the right level. Holding 1% is just not going to move the needle. It's not going to do the job in the portfolio that you want it to do. If gold gets very, very extended, then clearly we'll bring it back down to the mid-single digits. And if it's out of favour, we'll generally be adding, as we were back in 2020, 2021, 2022, and prior to that in actually 2018 when it was very depressed. To answer your question about this year, I mean, I think gold's sort of been fascinating, and it's often associated with sort of swivel-eyed loons. But in fact, who has been buying gold this year? Why has the gold price been going up? And it's actually not the swivel-eyed loon brigade at all. It's been central banks. It's been men and women in suits who have decided to increase their exposure to gold. Poland has specifically stated, I think they're going to increase their reserves from 15% of their reserves to 20% of their reserves. That is a process which is not going to take 2 or 3 days or 2 or 3 months, or it'll do even 2 or 3 years. It's a long process. When central banks start buying gold for their reserves, and it is a reserve asset, which I think people forget about, then they tend to do it for a prolonged period of time. Why are they buying? Why have they been buying so consistently? I think it comes back to February 2022, frankly. The invasion of Ukraine changed everything from the perspective of gold price. Back then, interest rates were beginning to go up. Everybody was thinking we don't need to hold gold because there's an opportunity cost, because interest rates are moving up. We're making money on our cash. We don't necessarily need to hold a non-interest bearing asset. But that was actually the wrong thing to do, on the basis that what these central banks were recognizing was that on the invasion of Ukraine, $320 billion of Russian assets were confiscated effectively through the international monetary system, and sanctions were imposed on Russia. And the global south, other central banks looked at this and they thought, this is the weaponization of the US dollar, effectively. We, for whatever reason, strategically, we think we want to decrease our exposure to US dollar within our reserves, and we would like to increase our exposure to other assets. They could have bought euros, they could have bought other currencies, but actually they decided to increase their exposure to gold. And pretty much month on month, since February of 2022, central banks around the world, this includes Poland, but includes Czech Republic, includes Singapore, obviously includes China in a very big way, who do it much more privately than other central banks, have been buying month on month, pretty much for those 2.5 years. So that is what has been going on in the gold price. And it hasn't been to do with interest rates, it's been to do with strategic decisions on behalf of central banks. And interestingly, and why I think that gold is not necessarily in a bubble yet, although it's been very helpful, is because actually Western investors have actually been selling. So since 2020, 2021, if you look at ETF exposures of in the West, whether it be UK listed or US listed ETFs, they've actually been declining in terms of their number of ounces. That has just begun to turn in the last month or two, few months, maybe the last quarter. But actually throughout the period where the central banks have been buying, actually Western investors have been selling. So the idea that there's some sort of massive bubble out there, not yet, it might turn into a bubble, but it certainly isn't a bubble yet. But that role within the portfolio is key, and importantly, we don't allow it to run away. So we keep it at 12. So actually, this year we have sold twice, both at about $24.50 and about around $2,600. We actually reduced for both personal assets and the Trojan fund, just modestly, but just to keep it at a 12% level, because we don't want the risk tail to wag the dog. So we want to manage that risk quite carefully.
Given your focus on capital preservation, what are the main risks for markets that you're seeing at the moment?
Well, I think there are always plenty of risks out there, and it's the things that are unexpected that affect markets. I think there's obviously a lot of talk at the moment about the budget. I don't think that's going to materially affect equity markets. Similarly, there's a lot of focus, thanks to the 24-hour news view of the US election, and I think that while that might affect markets very briefly in the shorter term, rather like it did with the election of Donald Trump back in November 2016, and 8 years ago, that was a sort of a 1 day, 2 day change, and really things settled down quite quickly. So actually, famous last words. But I don't think the budget or the US election are necessarily going to move markets dramatically. But what I do think is likely to affect markets on a negative front is geopolitics. Because geopolitics, if we saw with Ukraine and we saw with the 7th of October 2023, things that come from left field that aren't expected, markets are very good at discounting things, which so they can see gently ahead, but they can't discount things that happen very, very suddenly. And so that's why you see those jolts. And particularly in a stock market, which is actually quite highly valued by historical levels, the risk is that everybody runs for the door at the same time. And so I think that geopolitics, whatever that might be, and it's certainly something that the markets haven't considered, whether it be, Israeli hitting nuclear sites in Iran or something which, or China invading Taiwan, whatever it is, it's something which isn't currently expected in markets. That is a risk. And clearly we're moving, I think in a post-COVID world, we're moving to a period of higher geopolitical risk than the very benign period, frankly, which we were fortunate to be in prior to COVID and prior to Ukraine. So that's one thing. And the second thing that I feel that's fairly obvious is a recession. At the moment, a recession was expected to happen in early 2023. It didn't happen. And so it's sort of gone away now, and people aren't expecting it. People are expecting a soft landing. Central banks are talking about a soft landing, engineering a soft landing. Soft landings are very rare. They do happen, but they are extremely rare, particularly when you've seen the level of interest rate rises that we've seen. And don't forget, although people are talking about the interest rate cuts that we've seen since in the last few months, interest rate effects aren't felt for at least 12 or 24 months. So actually what we're feeling today in October of 2024 is the interest rate decisions that were made back in the first half of 2023, i.e. that period of going from 0 to 5%. That's what we're feeling today. The feeling of the cut won't really be felt probably for another 12 to 24 months. So there is this long and variable lag which people talk about. So I think that the risk is that the Fed is behind the curve, that the Bank of England is behind the curve, and they're cutting too late, and that actually we're already heading towards some sort of recession. That's perfectly possible, and it's certainly not discounted in markets. Markets are not looking for any sort of hard landing prospect. So I think those two risks are the biggest for the next sort of, say, call it the next 18 to 24 months.
One thing, though, that we can immediately see with those interest rate rises is that bonds are now offering a decent level of income, which has not been the case for many years. Given that you can get around 5% on money market funds, which invest in very low risk bonds, does this change your mentality at all in terms of the investment returns you're seeking to achieve?
It's a really good question, and it's one we've thought about a lot, in that we were in this remarkable era, which we always said wouldn't last forever. Certainly lasted longer than we were expecting, but from the financial crisis to 2022, we lived in an era of effectively zero interest rates and QE as well. So what we call an unorthodox interest rate environment. I mean, almost unprecedented in 6,000 years of monetary history. I mean, remarkable, really. And today we've seen a normalization. We've seen a back to where we started prior to the financial crisis, really. Interest rates prior to the financial crisis were sort of between 4-5%. And here we are, we're back to a normal rate of interest. Over the life of the fund, we've generated about 7% net of fees. So a sort of equity type return with less than bond type volatility. That's what we would seek to do over the long term. Over the shorter term periods, it varies. Naturally, depends on what markets are doing, depends on how we are invested. But that's what we've generated in the past. We were happy with those sorts of returns, perhaps slightly higher than that, during the interest rate environment prior to the financial crisis. Since the financial crisis, probably a slightly lower rate, but still mid to high single digits. And today, we recognise that there is a cost of capital. Frankly, I think that's a good thing, but I think we recognise that we need to be generating high single-digit returns over the medium term to justify, the probably 4% that people can generate, 4 and a bit percent people can generate either in the bank or from short-dated bonds. So I think we recognise that there has been a change, a dramatic change. I think you've seen that, funnily enough, you've seen it in markets. A lot of alternatives have actually fallen in value due to the fact that yields have risen. One of the things that we were very careful to do in recognition of this change that was always likely to happen, which is that we revert back to a normal interest rate world, is that we didn't have very high duration bonds within the portfolio. And we recognised that the world which we had been in, of bonds and equities being this wonderful yin and yang sort of cheek by jowl portfolio construction of a balanced portfolio of bonds doing well when equities do badly and vice versa. 2022 was a real wake-up call for investors that actually bonds and equities can fall at the same time if you were in a higher inflationary environment and a rising yield environment. And we knew that that was a risk and managed the portfolio accordingly and did pretty well in 2022 as a result of that, we didn't lose too much when other perhaps less liquid and more fixed yielding assets generally fell in value because yields rose. So we're aware of this change in dynamic, and we recognise we need to target higher, longer term returns. But we're not going to be seeking to take risk to generate double-digit returns, unless we really see those double-digit returns that are there, that are obvious within asset classes, within equities, for example. And one of the times we saw that was in 2009. Equity markets collapsed in 2007, 2008. They fell by almost 50%. The prospective returns from there were very high. They were double digits. And we moved up the allocation to equities to 75%. Today, our equity allocation is only 30% because the prospective returns are somewhat lower. If markets fell for the reasons that recession reasons, for a geopolitical reason, then the prospective returns would be higher, and we'd be very happy to increase our risk and therefore our prospective returns.
Sebastian, thank you for your time today.
It's a pleasure, Carl. Thank you.
So that's it for our latest Insider interview. Hope you've enjoyed it. You can let us know what you think. You can comment, you can like, and do hit that subscribe button. And hopefully, I'll see you again next time.